When investors begin looking at U.S. stocks, one of the first questions they face is whether to buy individual stocks or invest through ETFs. Retail investors often treat this as a simple choice. Professionals view it as a portfolio decision. This video explains how professional investors decide between individual U.S. stocks and ETFs, and why both are often used together rather than treated as alternatives. This is not a recommendation and not financial advice. It is an educational overview of how professionals structure equity exposure. The first distinction professionals make is between core exposure and selective exposure. For most portfolios, ETFs provide core exposure to U.S. equities. They offer diversification across sectors, reduce single company risk, and provide consistent participation in overall market growth. ETFs are often used to establish the foundation of equity exposure because they simplify risk management. Instead of relying on the performance of one company, investors gain exposure to a broad group of businesses. Individual stocks, on the other hand, are typically used more selectively. Professionals use individual stocks when they have high conviction in a company's long-term business strength or when they want to tilt a portfolio toward a specific sector or characteristic. Another major difference is risk concentration. A single stock can outperform significantly, but it can also underperform dramatically. ETFs reduce this risk by spreading exposure across many companies. Professionals evaluate this trade-off carefully. The question is not which approach is better, but how much concentration a portfolio can tolerate. Position sizing plays a critical role. Even when professionals invest in individual stocks, positions are often limited so that no single company determines portfolio outcomes. This approach allows investors to benefit from strong companies while controlling downside risk. Cost and efficiency are also considered. ETFs often provide low-cost exposure with minimal effort, while individual stocks require ongoing monitoring of earnings, competitive dynamics, and valuation. Time horizon also influences the decision. Investors seeking long-term market exposure may favor ETFs for simplicity, while those willing to research individual businesses may incorporate selective stock positions. Importantly, professionals rarely choose one approach exclusively. Many portfolios combine ETFs for stability and diversification with individual stocks for targeted exposure. This hybrid structure allows portfolios to participate in market growth while maintaining flexibility. Another consideration is emotional discipline. Individual stocks can create stronger emotional reactions because price movements are tied to a single company. ETFs tend to reduce this effect by spreading risk. Professionals design portfolios to minimize emotional decision-making, especially during periods of volatility. The key takeaway is that the decision between U.S. stocks and ETFs is not about finding the better investment. It is about understanding the role each plays within a portfolio. ETFs provide breadth and stability. Individual stocks provide focus and potential outperformance. Used together, they can complement each other when properly sized. For individual investors, the lesson is not to choose sides, but to understand structure. Portfolio construction, diversification, and risk control matter more than the specific vehicle used. This content is provided for educational purposes only and does not constitute financial advice.